This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, up until now, our studies of corporation tax are focused on the single company. We know how to prepare a corporation tax computation for a company. We know how to include the various content, whether that be trading income as adjusted for taxation purposes, whether it be property income, interest income, and of course in recent chapters, chargeable gains. We know that the summation of those items comes to a figure known as total profit. But total profit may or may not be the same as taxable total profit, TTP. Because if the company has paid during the chargeable accounting period any qualifying charitable donations, they will be deducted from total profit to give you the taxable total profit. What we now see involved is what happens when we're not just dealing with a single company that exists in isolation, but a member of a group of companies. Now, of course, already in your studies of financial accounting, you may have dealt with groups of companies. And what you may have seen there, if you have indeed studied that area, would of course be the process known as consolidation and the preparation of consolidated, i.e. group accounts. Now, fear not, there is no such issue when it comes to dealing with taxation. So far as corporate tax is concerned, each company, whether standalone, single, or a member of a group, will prepare its own individual corporation tax computation and be chargeable to tax on its own TTP, its taxable total profit. However, the membership of a group of companies, a group that will be defined in two separate ways: basic group structure, i.e. a 51% holding of a parent company in a subsidiary company, and thereafter, when we push that level of shareholding up to 75%, the membership of either just the bare minimum 51% or, more interestingly, as we will discover, 75% group holdings, that those will carry with them both responsibilities in terms of things that you must do, requirements of companies within a group put on them by HMRC, but also, and more interestingly, it leaves open reliefs, claims, elections that can be made. Now, of course, a taxpayer, whether individual or corporate, will only make such a claim, such an election, if it improves the tax position of the taxpayer, i.e. it mitigates the tax burden of the taxpayer. If not absolutely, then maybe temporarily, in the form of, for example, a deferral, as you'll have seen in terms of your capital gains reliefs applicable, i.e. that one rollover relief there. Now then, if we look now at the notes, we will see, as we've just said, if companies are within a group, then each such company must still prepare its own corporation tax computation. There's no taxation equivalent of consolidation, as we've just referenced in financial reporting, financial accounting there. Group companies will benefit from certain reliefs, but also have certain additional rules and regulations placed upon them. Now, which rules and regulations and which reliefs will be a function of the specific level of group shareholding, whether, as I said a moment ago, we satisfy the bare minimum 51% shareholding to constitute holding company or parent company, call it as you will, and then subsidiary company, or then, and again, as I've said, more interestingly, where we step that shareholding percentage up to 75%, where rather more elections become available, i.e. things that will indeed improve the tax position of the group. A group exists for tax purposes, of course, where one company is a subsidiary of another company, your basic parent company, subsidiary company relationship. The various reliefs and rules are only applicable to members of certain group structures. As we've already mentioned, those two group structures are 51% groups and 75% groups. And as we'll see now in notes 1 and 2 here, we have issues that pertain to any member of a 51% group, and then those that are specifically only available, let's try to underline that rather than cross it out, to 70, not very good with straight lines today, to 75% groups issues there. Right, under the 51% groups issues, something that we have already referred to back in Chapter 16, related 51% group companies. Now again, let's just draw up a very basic little picture of what a group structure might be. So we may have our holding company, we'll call it H, that has direct holdings in each of S1 and S2. Now, we'd expect most group shareholdings to probably be 100%. In an exam question, although that may happen, it's possibly unlikely, certainly in the more interesting of the exam questions anyway. So let's say that holding company here, H, owns 90% of S1 and 100% of S2. So we've got a holding company and we have got direct subsidiaries of that holding company. What, of course, we may also have is indirect subsidiaries, i.e. where the subsidiary companies, here S1 and S2, are themselves parent companies of their own subsidiaries. So we'll create here, of course, S3 and S4. And what might we find here? Again, different levels of shareholding, maybe 80%, and let's have 80% there as well. So we've got the holding company, parent company, H, direct subsidiaries, S1 and S2, indirect subsidiaries, S3 and S4. Now clearly, in relation to 51% group issues, it would appear that the H group of companies satisfies the criteria. Now, of course, what we'll start to do from note 2 onwards is to look at the detail pertaining to each of these areas, and we'll diagnose the group relevant to 51%, and as we interpret it, 75% group issues as we go through each of the areas. But we've got a parent, a holding company, we've got direct subsidiaries, we've got indirect. Again, if at this point you have no recollection of discussing related 51% group companies back in Chapter 16, I think it'd probably be a good idea that you actually go back and check those notes out before we try to advance our studies any further. Maybe, of course, it's been a while since you looked at Chapter 16, so please go back and check that out. If we don't understand what we're doing with a single company, we're going to struggle to understand what we do with a group of companies. Some of the main areas we'll be discussing when we come to 75% groups issues, the most commonly tested issue, group relief of losses. To be able to understand that, you need to know how to deal with losses within a single company. And with our current year claims, current accounting period, our carry-back claims, our carry-forward claims. If again you cannot recall those, then go back and check out, of course, please, Chapter 18, that deals with the corporate tax losses that are available. There it focused on a single company, but we did make reference, you will see within the notes, you will have heard within the lecture there, references to group relief of losses. So please do go back and check out those issues before you take this lecture any further. Okay, so what do we mean by related 51% group companies? Firstly, a definition here. Companies are related 51% group companies if one company is clearly a 51% subsidiary of the other, or they are 51% subsidiaries of another company. In terms of what do we mean by that control, that 51%, a company is a related 51% group company if the parent company owns directly or indirectly more than 50% of the share capital of the subsidiary company, and note when, at the end of the previous chargeable accounting period. At the end of the previous chargeable accounting period. The significance of that I'll discuss with you as we go through this lecture, this chapter. Going to be more than one lecture, I regret to tell you now. One thing we can do is to exclude any companies that you are told are dormant, and have been dormant throughout the accounting period, but overseas companies would be included. Now, that's the level of knowledge that we simply have to have re-overseas companies, because overseas aspects of corporate tax are not a part of our syllabus. In relation to that, what are the tax implications? Now, again, if you heeded what I said about 2 minutes ago, and you have gone back to look at Chapter 16, you'll have seen in Chapter 16 the profit limit of 1.5 million. A figure, of course, that's given on your rates and allowances page as well, that you have with you in the examination room. Used to determine if a company is large and is therefore required to make quarterly instalment payments. Now again, you do not yet know the detail of quarterly instalment payments, but in Chapter 16, and when discussing loss reliefs and the objectives to get the best use out of our losses, there within Chapter 18, we have made reference in both cases to the quarterly instalment payment system. The details of it, well, that awaits you in your next chapter, Chapter 23, where it will be explained. But suffice it, of course, to know, as we have stated all along, what we do know is that a company that is not large will not have to make quarterly instalment payments and will only have to pay its tax 9 months and 1 day after the end of the chargeable accounting period. So there's a decent period of time between making the profits and then having to pay the tax thereon. If you have to make quarterly instalment payments, then you're going to start to pay your tax a whole lot sooner than you would otherwise have to do. Now, as you'll have read, and again we'll have noted, and you'll see in more detail in Chapter 23, that if a company is a large company, then it may have to make quarterly instalment payments. Notice I use the word may, because there will be other factors that come into play there, again, detailed in our next Chapter 23. But if a company does have to make those quarterly instalment payments, it means it's going to start paying the tax for an accounting period a whole lot sooner than it would otherwise have had to have paid that tax. And for most companies with 12-month accounting periods, most companies prepare their accounts, as we know, to a given year end, but with a 12-month accounting period, they're going to have to start paying that tax. Don't worry about noting this next statement down, it's in Chapter 3. But they're going to have to start paying that tax just over halfway through that 12-month accounting period. So while they're still making the profits, they're only just over halfway through their 12-month accounting period. Rather than waiting until 9 months and a day after the end of the period to pay all of their tax, they have to start making quarterly instalment payments halfway through, just over halfway through the accounting period. Clearly, that is something that if a company could avoid doing, it would seek to so avoid. It's going to have an extremely adverse cash flow effect in relation to when they have to make what may be very significant corporate tax payments across to HMRC. So, when does a company have to make them? You see in Chapter 23, you'll see the criteria for that, but it's only going to impact on large companies. Now, a large company is a company that has profits as defined, we'll talk about that again later, and that has profits as defined in excess of the profit limit. But the profit limit for a single company with a 12-month accounting period, as you already know from Chapter 16, is 1.5 million. But, and hence the significance of related 51% group companies here, that if companies are within a group, there are related 51% group companies, then what must we do? We must divide that profit limit between the number of related 51% group companies. So if we now look at our H group of companies that we've scribbled here on our notes, we would have to determine how many related 51% group companies there are for this accounting period, and then redefine the profit limit accordingly. So, what have we got? We're told there that control is based on direct or indirect more than 50% of the share capital. Right. Clearly, H is related to S1 and to S2. 90%, 100%, clearly more than 50%. Then indirect. 90% of 80% is 72. So we have an effective 51% holding. 100% of 80%, effective 80%. We have a 51% holding. So what we can see here is that all of these companies within the H group of companies are related 51% group companies. How many of them are there? There are, of course, 5. Therefore, a profit limit that was 1.5 million will be divided by 5, and therefore give us a revised 300,000 pound profit limit. Now, of course, anything that reduces that profit limit makes it more likely that when we compare the company's profits with that profit limit, they are more likely to exceed that profit limit, therefore be large, and therefore may possibly be required then to make quarterly instalment payments. That is a critical issue in terms of the cash flow of the company here, of the group of companies there. Now, I've divided it by 5 because you can see here 5 companies. But remember what we also were told, that companies are only related if they were related at the end of the previous chargeable accounting period. So, if any of these companies were acquired part way through the current accounting period, for example here, maybe company S4, maybe S2 only acquired its 80% interest in S4 part way through the current accounting period. That means it was not a related 51% group company at the end of the previous chargeable accounting period. So for this accounting period, whichever year end this may be, there would only be 4 related 51% group companies. So instead of dividing the 1.5 million by 5, it would instead be 1.5 million divided by 4, and that means we'd be looking at £375,000 as the revised profit limit, a higher figure. The higher, of course, the figure, the less likely it is that a company will be classified as large and therefore may have the requirement to make those quarterly instalment payments. So we only want the number of related 51% group companies at the end of the previous chargeable accounting period. The sort of exercise I've given you there is the sort of exercise that you could see presented in a Section A objective testing question, where you have to define what the profit limit will be for each company within the group there, or it may be specifying a particular company within the group. So we take the number of companies, related 51% group companies, based on the position of the group at the end of the previous chargeable accounting period. Okay, now again, the full quarterly instalment payment system is explained and given examples of within chapter 23. So you'll see the detail of that. But that's the important significance of related 51% group companies in defining the profit limit, and then in establishing in relation to that profit limit whether a company is large or not large. Okay. When dealing with the tax implications, we've made reference there to the profits of the company, the profit limit. That profit is going to be very specifically defined as being, now again, hopefully you went back to and looked at your notes on chapter 16. I hope you recognise this now. That's where you were told when a company normally pays its corporation tax. Here is where we're introduced to the idea of what is a large company whose profits exceed £1.5 million, and there is a very specific definition of profits there. It isn't just the TTP of the company, it is plus dividends received, excluding dividends from related 51% group companies, i.e. from subsidiary companies. Now, again, in various texts, and indeed in some of the answers I'll provide to you to some of the questions you'll be doing in this chapter, you may see, rather than just the term profit, which is the one used by the examining team, you may see reference to the term augmented profit. Now, that's the technical term that is given to define very specifically which profit figure we're talking about, to separate it from the term, which we know, total profits, taxable total profits. The augmented profit is, as you see here, TTP, again, plus the dividends received from non-subsidiary companies. That's augmented profit. That is the figure that is therefore compared with the profit limit that will have been divided by the number of related 51% group companies that existed at the end of the previous chargeable accounting period. Again, make sure you've understood that. That informs what we're now doing here in relation to these companies in this chapter. Right, you then got example 1. A Limited owns 100% of the share capital of V Limited, F Limited and C Limited. So A has got 3 direct wholly owned subsidiaries, B, F and C, and it has a taxable total profit of £400,000. Is A Limited a large company for purposes of making quarterly instalment payments? Now, there's nothing there to inform you that either any of the shares in V, F or C were acquired during the current period, so we assume that therefore that is a continuing position, and those were the shareholdings that A Limited had at the end of the previous chargeable accounting period. Therefore, there are how many related 51% group companies? A is related to each of its 3 subsidiaries. A plus the 3 subs is 4. As we've already seen, 1.5 million divided by 4 equals £375,000. Therefore, with a taxable total profit of 400, irrespective of whether it has any dividends received from non-subsidiary companies, 400 is already in excess of 375. It is therefore a large company for this period, for purposes of whether or not quarterly instalment payments may or may not be required. Yes, we've got above now that figure. I'd like you therefore just to think about that and then to review through the answer to example 1, and I'll join you in a few moments after you've had the opportunity to pause this and to review through that answer, because it brings in just 1 or 2 other little issues there that I'd also wish to explain to you. So pause at this point, review through the answer to example 1, and I'll just discuss 1 or 2 issues from that with you in a moment's time. Okay, well, hopefully you've read through now the answer to this, and there'll be a few new things coming to your attention here that, again, don't worry, are dealt with in detail within the next chapter 23, but as you haven't yet done that, it's, I think, appropriate that I just discuss these issues with you. To begin with, of course, you see the calculation of the revised profit limit, based indeed on there being 4 related 51% group companies at the end of the previous period. TTP of 400,000 will therefore be a large company, and now the bit that we weren't aware of. If it was large in the previous chargeable accounting period and is now large in this period, then it means that we should have made quarterly instalment payments for this period. Now, how much those quarterly instalment payments are, well, that will be based on an estimate of the profits of the current period. But we should have made those. Whether we made the right estimates, of course, is another issue, but we should have made quarterly instalment payments. The criteria, therefore, for a company in terms of, for this, the current period within which we are currently still in, should we make quarterly instalment payments for it? It is based on, were we a large company in the previous accounting period? First of all, if we were not a large company in the previous chargeable accounting period, then it doesn't matter what size we are this period, large or not large, no quarterly instalment payments will be required. If we were large in the previous period, then as soon as we were large in that period, what we would have been required to do to fulfill our obligations under these rules is to estimate what the profits would be for the current accounting period, the one that has now started, the one within which we are now based. And if we estimated that the profits of this period meant that we were also large in the current period, then quarterly instalment payments will indeed be required for the current period. But it requires the combination of those two things, that we were large in the previous period and we are estimating for us to be large in the current period. Now, those quarterly instalment payments, as I keep saying, you'll find out in the next chapter, will be based on the estimated profit of the current period. Those payments would then be required to be made on the various due dates. And again, as their estimates, of course, it may lead to under or overpayments at certain points in time. And that too has consequences that are dealt with within Chapter 23. If, of course, now that we know we are large in the current period, because we've got a £400,000 TTP, then if we estimate here that we are going to have profits in excess of the profit limit for the next accounting period, then the next accounting period will require quarterly instalment payments to be made for it. So, and will be required to make quarterly instalment payments for the next chargeable accounting period if it's estimated that profits for that period will exceed the profit limit, as we know, of £375,000. That is assuming there's no changes in the group structure before the end of the current chargeable accounting period. One further point, if our TTP had been, say, 350, now 350 would be less than 375, but it is not the TTP that you compare with the profit limit. It is this augmented profit figure that we have referred to. So if A Limited received dividends from non-subsidiary companies of £40,000, then its augmented profit figure would be 390. 350 plus 40, 390. 390, that of course does exceed the revised profit limit of 375 for each group company, and again it would therefore be a large company. Okay, so to understand the precise mechanics of the quarterly instalment payment system, that you'll see in Chapter 23, you'll need to deal with in Chapter 23, but again at this point in time, what is going to create a requirement to make quarterly instalment payments wherever we see profits for a company exceeding the profit limit. So you've got to be able to compute that profit limit and then compare the augmented profit figure with it. Okay, back to our notes now. In terms of 51% group companies, what other issues? We've dealt with the first one, related 51% group companies. We've not yet dealt with, but it's coming up soon in Chapter 25, VAT. And if you are in a group, what will then be available? It is not compulsory, but you can elect to go for group VAT registration. Again, it's based on a 51% level of shareholding, not 100%, not 75%, but a 51%. Your basic group parent company, subsidiary company requirement of a shareholding. It's more than 50%. You don't yet know about VAT, But what a company, what any business will have to do is to submit VAT returns, normally on a quarterly basis. Normally quarterly, 3-monthly VAT returns will have to be submitted. And normally what that will involve is us as the business, the trader, paying out an amount of VAT to HMRC on that regular quarterly basis. Any VAT registered business has to submit a VAT return, but if you are within a group VAT registration based on 51% group membership, therefore, then what you're able to do is to choose instead to join those companies within your group into a group VAT registration, and that would mean that you only have to submit one group VAT return rather than several, maybe many, individual VAT returns. Now the details of that, as you can see there, are within Chapter 25. We'll discuss it at that point in time. The third little point, something we do know about, the availability of AIA in capital allowances are 100% allowance are AIA. But of course there is a limit placed upon us, and that's £200,000 for a 12-month accounting period. Well, not only is it $200,000 based on a 12-month accounting period, but as you'll see here, we have a further restriction, that is only one AIA is available to a group of companies. Again, a group defined by membership of a 51% group. But the group members can allocate the AIA in any way it chooses across the group. So we've got a finite £200,000 based on a 12-month period of AIA available. We already know if you were dealing with a single company, you could choose to allocate that AIA, and you would choose to allocate that AIA, firstly to any special rate pool expenditure incurred rather than any main pool expenditure incurred. That only relevant, of course, if the total expenditure exceeded £200,000. You would firstly use the £200,000 on special rate pool expenditure. Now what we discover is that not only can you get to choose within a company where the £200,000 limit is used, you now get to decide which companies within a 51% group will have any access to any part of that AIA limit of £200,000. So you as a group can carve up that £200,000 AIA limit in any which way you choose within your group of companies to be able to get the maximum taxation benefit from that AIA. So as I said, a group therefore may choose to allocate the available AIA to firstly reduce the profits of large companies below the relevant profit limit. Hand in hand with what we saw a moment ago, we saw a company in example 1 where its profit of £400,000 exceeded the profit limit of 375. Now, if there was capital expenditure, qualifying plant and machinery that was incurred within that company, where we could have claimed some £25,000 or more of capital allowances of AIA, then by allocating some part of the AIA limit, there at least £25,000, to that company, we may be able to further reduce the profits of the company, and in so doing, remove it from any requirement to be making quarterly instalment payments. That would be a hugely beneficial cash flow impact. That, of course, notwithstanding the issue that we already know, that we may be deciding to use the AIA limit in companies where there is special rate pool expenditure rather than companies where there is only main pool expenditure there. Okay, and as we've said, and as always, to special rate pool expenditure before main pool expenditure. Okay, Now, those are the basic provisions that relate to basic membership of a 51% group. Make sure you're happy with those, other that is than the group VAT registration, because that awaits us in Chapter 25. Deal with those before we then move on to where most of our time is devoted to, and most key examination questions issues would be devoted, mostly to the issue of group relief. Now then, I would ask you, before coming to the next lecture where we deal with group relief, go back to Chapter 12 and make sure you've revised through what a single company is able to do with its losses, because early on in our studies of group relief, I'll be testing you on just that, to make sure that you do understand what a single company can do, before then we move on to see, well, what happens if a loss-making company is actually part of, as we'll define it, a 75% group. The concept is a simple one, that a loss sustained by one company within a 75% group may be surrendered in part or in full to go against what will be the TTP, the taxable total profit, of any other 75% group member. And as we'll discover, and the beauty of this, for those losses that are available for group relief are available to be surrendered to a claimant company within our 75% group, we've got flexibility, total flexibility, as to how much of the available loss we set against how much of the available TTP. But check out Chapter 12 before you move to the next lecture.